I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Top-tier MGA CFC Underwriting has undergone some very well-publicised leadership changes in the past few months, and Andy Holmes is the business's newly appointed CEO, so I'm delighted to have him on the show as this week's guest. Andy's been part of this organisation since very early in its remarkable growth story and was previously its Chief Underwriting Officer, so he knows the business inside and out. Nothing was off the table in this discussion, so he started where we needed to, but soon got swept away in a whirlwind of new product launches and insights into the world of cyber, embedded insurance, parametric covers, and of course, artificial intelligence. Andy is incredibly engaging and easy to talk to, and in this podcast he reveals a huge amount of accumulated insurance business wisdom and fills in many details about CFC's original and highly successful insurance philosophy. Listening back to this interview, it's clear that although CFC may have had big changes at the top, it's definitely not slowing down, and its body corporate and innovative culture remain as effective and worth studying as ever. Enjoy the podcast. Andy, welcome to the Voice of Insurance.
Thanks for having me, Mark.
There's been a change of leadership at CFC, obviously. You're now CEO. With that change, what should we expect from a cultural level at CFC? What do you think we should expect to see changing?
Well, so much of CFC's culture was and is great. I don't think you achieve what we have achieved over a 24-year period without the fundamentals of your culture being excellent. What we need to do now is evolve our culture for the bigger business that we've now become. We're nearly 1,000 staff. We need to ensure that there are the right safeguards in place to ensure the staff can feel like they can be themselves at work, feel heard, feel safe. But we still want that passion, that entrepreneurialism, that sense of fun that embodied CFC and made it a distinctive part of the London market. So, I hope that so much of what you'll see in the future is what you've recognised in the past, just with a subtle evolution.
Because it's just different when a business is 5, 10, 20 people.
Exactly, yeah.
And suddenly 1,000, I suppose you can't know all those people, you can't see all those people every day, they're not sitting in the same room. And
Yes.
Suddenly you have to institutionalise things.
That's exactly right. I've been at CFC for 21 years. It was 7 people when I first joined. You could see all of the 7 people and you know them really, really well. And therefore you can have an unstructured cultural environment, which is completely appropriate to that size of business. But when you're approaching 1,000 people, there needs to be more structure, there needs to be more control, and there needs to be more safeguards. And that's what we're going to have going forward.
Yeah, it's the most fun thing about a small business is actually you can see them, but also you can hear them. That's the other thing. Yeah. You can hear them on the phone and you can learn so much from just listening to someone else negotiate, or as a journalist, negotiate a difficult situation, or sort of ask a question in a skillful way that got an interesting answer.
Yeah, it's that learning by osmosis. Just sitting next to David Walsh or Jonathan Swan in the early days of CFC and listening to how they did things, for me, was a fantastic learning experience. We need to make sure that still goes on at CFC, that people feel that close interaction with their colleagues, that meant we had a distinctive culture, but appropriate to the size of business we are now.
Well, we'll see how you get on. But I've come back into your office building before and after, and I haven't noticed any difference so far.
Good. Plan's working.
So why don't you give us a bit of a roundup of where you are at the moment? Because usually you're quite a fast-moving target at CFC usually. So where are you in terms of the size, sort of GWP, that kind of thing at the moment?
So in 2023, we wrote just under 1.25 billion US. And I talk US now just because it's our predominant currency. And in 24, we are hoping to write 1.5 billion US. So it's getting some real scale now in the business. But it isn't all about scale, as you'll have seen from our Lloyd's syndicate, which essentially tracks the MGA. The underwriting results underlying that are very strong. And really, that is our focus more than just the top line, although clearly we want to see the top line grow too.
You mentioned about the Lloyd's syndicate. We might as well talk about it now. It's starting to mature, and obviously the results have been excellent, absolutely excellent, which is within Lloyd's, you don't expect the business to make any kind of traction, and it's hard to make any kind of profit or be allowed to make a profit for the first 3 years.
Yeah.
But you've managed to be way ahead of that. In terms of running a Lloyd's syndicate, is a different set of problems or a different set of skills from running an MGA, but only subtly different.
Yeah.
How's it been, that experience? What's your kind of report card on it?
Yeah, so, I mean, we started the syndicate in 2021, and the idea there was that there is an enormous universe of capital out there that isn't in the London insurance market. And that capital, when it does touch the world of insurance, tends to experience it through catastrophe exposures. So high volatility, high risk. And our portfolio is very different. It is low volatility, high predictability. And we felt that there was an appetite from that capital to access our portfolio. The problem is we didn't have a vehicle through which they could access it. And that is the Lloyd's Syndicate. It turns interested capital into usable insurance licenses. And Lloyd's has the best licenses in the world. And Lloyd's at the same time in 21 was also looking to dial down its own volatility profile and at the same time get access to a small business portfolio, which doesn't often come to London. And that's what we have. So Lloyd's were really supportive through the setup there, and absolute credit to the team at Lloyd's for standing us up in real quick time. We raised the capital in 6 weeks. And the thing is about our syndicate, whilst it was a new syndicate in 21, it was actually accessing a 21-year-old portfolio at that time. So not a new book of business, just a new, essentially, capacity provider accessing that portfolio, which gave it year one meaningful scale. And also the syndicate is very atypical of a Lloyd's syndicate. It is only active 1 day a year, 1st July, when all the CFC MGA binders renew. It has no staff whatsoever. We second a couple of CFC MGA people to the syndicate, but beyond that, it has no staff costs. And it has no box in Lloyd's because the active underwriter, and he's probably the least active of active underwriters because he's active 1 day a year and he puts 7 lines down and his work is done. I'm being a little bit harsh to Matty.
Can I have that job?
Yeah, I know. That's it. Yeah, why didn't I get that? But, so the syndicate is very modern in that sense. It is a virtual syndicate. And therefore, the only costs it has, the operational costs, are essentially managing agency charges and Lloyd's charges. Outside of that, it has no costs. And therefore, it was able to achieve the results it did in year one.
Because you don't have all that grind.
Because you don't have all that, yeah.
Often
Exactly.
where, I suppose, a genuine startup has got to pay for the turnkey at the same time as they're actually building and hiring their own people for when, maybe year 4 when they hope to fly off on their own.
Exactly. Yeah. And Astor obviously are excellent in providing all that sort of functional breadth you need from a managing agency as a complete plug and play. So they were superb from that perspective. So really, it was a startup 21-year-old syndicate. And from that perspective, it was able to achieve the results it has in its first year.
Lloyd's had already been accessing, this wasn't necessarily new business to Lloyd's because Lloyd's syndicates have been supporting you for all those 21 years.
Yeah.
So they already knew that was good business.
Yeah. I mean, we had a very, very demonstrable track record. And one thing we do have as a business, being around for 21 years and only closing on our first ever insurance acquisition today, is we have a hell of a lot of data that is in one place. We have a single source of the truth, which is obviously one of Lloyd's ambitions through Blueprint 2. And therefore, we're able to not only interrogate that data easily, but demonstrate it to people like Lloyd's to say, this will be profitable. And actually, from John Neal down, they got that really quickly and were able to create the syndicate in record time.
Sorry to interrupt in mid-flow, but this is just a reminder that you could be advertising right here, right now, and getting your message directly into the ear of key decision makers in the insurance industry. And you'll be doing it while they're absolutely in listening mode. The podcast is the medium of the future, and so is audio advertising. Contact me on mark@thevoiceofinsurance.com, and I'll do everything I can to get you started. In terms of your relationship with those existing suppliers, obviously you've got a relationship as a syndicate where you're managing capital. Your one piece of work on the 1st of July is to put that capital towards this MGA, this great MGA that you know, called CFC Underwriting, and that's how you do those 7 bits of underwriting there. But has that changed your relationship at all? Obviously, it is a different job. You're talking directly to the people who've got money about what returns they should be expecting to make and how much capital efficiency you might be able to give them and all that kind of different, more grown-up kind of conversations about your solvency. And presumably you've had to do a Solvency II own model.
Indeed.
So, so take it all back about that guy only doing a tiny bit of work. There's a huge amount of work that went on before
Matt's
that.
going to kick me when he hears this.
I think, yes, Solvency II own model approval sounds like a really painful thing to have to do. It doesn't take more than just one
I leave
afternoon.
that to cleverer people than me. So.
But how's that changed your relationship? Well, see, that's a real maturation of you. If you Normally, you have to keep the paper provider happy, and now you understand what the paper provider has to do to keep their capital happy.
Yeah, you develop greater empathy for a start. And it does help that the underwriting leadership at CFC, and until very recently, I was the CEO here. I was a CEO for 13 years. But I started life. My first touch point with CFC was on the capacity provider side. Matt Taylor was active underwriter on this very floor in this very building for Montpellier Syndicate, and then joined CFC. And Dan Truman, who's now our CEO, was until very recently at Axis. So we have that intrinsic empathy. But what we've never really been able to demonstrate truly is that we are shoulder to shoulder with our capacity providers, which are 27 Lloyd's syndicates and 3 insurance companies. They take risk on our MGA's portfolio, and now so do we. And CFC, the MGA, is also a significant capital provider into CFC, the syndicate. So we are genuinely shoulder to shoulder. And many of our syndicates now are employing their sort of smart follow vehicles to access CFC, and they take a broad share of our portfolio, just like our own syndicate does. So really, our syndicate's results are their results. And for true alignment, we've never had a better period. So they welcome it. When we broke the news to them in 21, they really welcomed that alignment at that time.
So they didn't take it as a threat or as a sort of, are you running off with somebody else?
Well, it is a delicate conversation. That, clearly as the syndicate has grown, there's questions around, are you going to eat our lunch? But the syndicate really is standing still in the share it takes of the MGA's portfolio. We feel it's reached its sort of optimum level. And because we welcome, obviously, third-party capacity providers, I mentioned the 27 and the 3, and a lot of those are long-standing partners. And they were with us through difficult times when the hard market arrived and there was a deficit of capacity for MGAs. They stood with us through those difficult periods. So we're absolutely not going to eat their lunch just because perhaps we can, given the syndicate's results and the capital appetite for that type of portfolio.
And I suppose with that, you've got that natural inertia within the Lloyd's accounting system anyway, that these have to be, just by definition, longer term supporters, because you can't just go in and out of Lloyd's, in a year.
Indeed. And talking to the capital, they need to be in really for a minimum of 3 years. And their tenure beyond that is really down most of the time to the loss ratios you're able to produce. And I often think, when you've got all these competing dynamics around top line and capital and private equity and all these things, if you look after the loss ratios, everything else looks after itself, really. And that's our focus here.
If you keep putting in numbers like that, you're not really going to have a shortage of people wanting to support it, is there?
No shortage of capacity or capital or investment, or indeed people wanting to come and work here.
There's not ever a shortage of people who are quite keen on making money.
Yeah, exactly. Yeah, let's hope not.
New stuff. This is kind of proof of the pudding that you were saying about keeping the culture going, keeping that entrepreneurism alive. You recently launched a carbon credit delivery product.
Yeah.
Tell us all about it. I mean, I've had people doing similar things on the podcast recently. I must say, that was fascinating. Tell us all about what you've been up to.
So we have George Beattie here as our head of innovation. And George is a fantastically visionary guy, an insightful guy. And
someone's been on the podcast probably more than once, and I don't want to big him up too much, but I would say that was a good hire.
Yeah. And actually, he's a returning CFCer as well. He's a boomeranger, and we've got a few of them now. So George was here in the sort of mid-teens. But as part of his innovation team, he has created an insurance product that essentially, as a company, some companies are compelled to buy carbon credits if they're in high carbon consumptive sectors. For others, it's a voluntary undertaking. And so they buy forward their carbon credits. But sometimes the underlying project which delivers those carbon credits fails to deliver. And in that situation, it would be very costly to replace those credits because you've made your commitments around what you're going to do in reducing your emissions. So it would be very costly to replace those credits. So that's where the insurance steps in and essentially pays for the cost of replacing those credits so you can fulfill your commitments around your emissions. The way we go about it is we underwrite the underlying project. So not the buyer of the credits. The buyer of the credits is the insured, but we're actually underwriting the project itself.
Yeah, so I suppose probably the easiest thing is to think of planting a load of trees somewhere.
Exactly.
But there's a lot more to it than that, I think, isn't there? Or doing things that reduce emissions generally.
Yes.
Or actually now extracting CO2 out of the atmosphere.
Yeah, exactly.
So there's a whole load of things. So it's the efficacy of that, but also it's the kind of execution risk and the credit risk. Because what if that person who said, look, give me £1 million, I'll go and plant a load of trees somewhere. and then they take the £1 million and they don't end up planting any trees, or they've never had the permit to do so, or whatever. They never have permission, or whatever, things that go wrong. Obviously, the forest can burn down.
Indeed.
Or the trees don't actually sequester as much carbon as because they're the wrong type of tree.
Exactly.
For that climate or something. They take 80% of the carbon they were going to, so you can lose out that way as well.
Exactly. Or sometimes they're in parts of the world which are not the most politically stable.
Yeah, because it could be nationalised, couldn't they? Or
Exactly. A unique feature of this product is it also does cover that political risk.
Yeah, that's the thing. That I think that's the USP that's moved the product onwards. I think that makes it a more sophisticated product.
Exactly, because one thing that George and the team have done is talk to a lot of buyers about what would motivate them to buy insurance. And actually having a product that covers off most of the risks that they worry about really for them was the mover to being buyers rather than non-buyers.
Almost an all risks policy, isn't it?
Exactly right. So there are thousands and thousands of these projects around the world. George and team have identified a cohort of high quality projects that they'd be prepared to take the risk on. And then to the extent that buyers are buying credits on those projects, we will underwrite them.
And the prime driver for this is probably a lender or an investor, isn't it?
Exactly.
Saying, yeah, well, I could give you 5 million for this project now, but I'll be able to give you 20 million if I can get it properly insured by someone respectable.
Exactly. And they're exactly the sort of buyers we're talking to right now as the early purchasers of this product.
It's one of those good products where insurance is helping to multiply the effect of the capital that's already there from the bank or from the investor.
Exactly.
So it's one of those good ones where it's kind of becomes a virtuous circle.
It absolutely does.
Finance more demand, and then everyone else can see that more is happening, and then more demand comes.
Yeah. And we're hoping those lenders, because we are very carefully diligencing the range of projects out there, that they will come to trust that the high quality end that we're prepared to insure is also the high quality end.
Because insurance is doing its job of being that second opinion and being that endorsement and that guarantee to say, well, these are the good ones. And if they won't insure the other one, then I know that they've checked them out and and probably put them in my really risky bucket.
Exactly. Yeah. So we're hoping it becomes exactly that virtuous circle that you described.
Because it's one of these classes of business that has a huge potential because of net zero by 2050. Mm-hmm. People have been describing it as maybe the next cyber. The fun thing is talking to you. You're the person who did the actual cyber. Yeah. So does it feel a bit like that to you? Do you think it's that kind of potential?
It does. The early days of cyber, and I joined CFC in 2003, the early days of cyber were characterized by a lot of talk and not a lot of dollars. But here we are later, and the cyber industry depends on your
I remember that there was a computer prime policy in 1992, and I walked into my office and a young graduate, and I thought, this is really interesting. And it's like, but it was just covered in dust.
That's it, yeah.
Has anyone ever bought this? No.
Yeah, that's it. I remember driving up and down the M1 and stopping at sort of Nuneaton, I remember, and sort of going to Liverpool and talking about cyber. And they were just, look, I'm really not interested. Can we talk property casualty, please? They're absolutely interested now. And it's, a $15 billion market or whatever commentator you speak to. So, yes, it does feel in that position that cyber was in those early 2000s. But like cyber there, where we were at the start of a technology revolution. The first dot-com bubble had burst, but technology wasn't going anywhere. So the underlying risk was structurally growing, and insurance had to respond. For carbon, it feels those same characteristics are present.
It's not going to go away. I mean, the tide will go in and out a bit, and obviously the politics waxes and wanes all over the place.
Absolutely.
But fundamentally, it looks like climate change is real, and we're going to have to do something about it at some point.
Yeah. So the structural risk is growing. And it's up to the insurance industry to make itself relevant to that new risk. And it's really important as the global economy spends a smaller proportion on insurance than it ever has done, that we refresh our relevance to businesses who buy insurance.
What else is bubbling in the cauldrons of innovation of CFC?
Yeah, so it's great. We've got George and team, and they've, as well as doing the carbon products, they've been focusing on embedded insurance, so taking existing types of insurance. The most recent one would be transaction liability, and embedding it in platforms that buy and sell assets online, and making that type of insurance part of the buyer journey, but very seamlessly, such that rather than customers coming to insurance because they feel they've got a risk, is they can buy insurance as a point of convenience. And that's something that we found over the years at CFC. If you make insurance really convenient, people will buy it. For example, most customers who come to CFC looking to buy one type of insurance tend to leave with two. Over 2/3 of our customers leave with two insurances when they're meant to buy one. That's because you make insurance easy. I was talking to my daughters the other day and say, right, do you want to get into insurance? It's great fun. They're about to leave school and everything else. And like, no, that's so boring. I think insurance has a PR problem. And the PR problem is because the onboarding process, you have to fill in a long application form. And then you're an annual one and done exercise. And the insurer leaves you alone, doesn't really help you till they seize you this time next year. What we're doing more as points of innovation is trying to make the digital capabilities that we have here, and we've got 120 software developers, make that customer experience of insurance better. So don't ask them to fill in a long application form. Ask them for one piece of data. And actually, in this day and age, you can fill in the rest yourself and learn way more about the customer than they ever could tell you about themselves. But also look after them during the year, such that if their exposure changes or if there are new threats out there, we can help them with that and be much more of a promise to protect rather than just a promise to pay. So that's how we're deploying our technology, and where that's manifesting itself. We're seeing a lot of growth in transaction liability through the embedded insurance that I've described. We have a very diversified portfolio. So we're seeing growth in some of our lesser known lines like marine war and marine piracy for obvious reasons at the moment. But we're also seeing geographical growth, geographical footprint. For 24 years, we've really traded from one location. And as a hard market transitions to a soft market, we feel like now is the time to be closer to our customers. So we've just closed out the acquisition in Australia.
Well, actually, let's talk about embedded before we talk about that.
Yeah.
Because embedded is really interesting. And it's certainly in the insurtech community, it's one of the things that they've discovered, which is funny because, of course, embedded insurance has been around forever. I remember having Assurant on the program, and they've been around for 40 years doing embedded insurance, doing it very well.
Yeah.
It's also got a bit of a checkered history in some ways, because obviously everyone knows that embedded insurance that we all probably least like is that deductible buy down that you get at car hire.
Yeah.
And you think, oh, this is not a good advert for the insurance industry. And you think, yes, hopefully you're doing it in a much better way, because of course, you can embed competitiveness, fairness, relevance, and you've got to embed these days knowing your customer pretty well and knowing that you're not mis-selling them something, because you'd be terrible to embed a mis-selling into something.
Yeah.
So you're the good guys in the embedded. You're making something really convenient and also good value and a good product that is worth buying, right?
Yeah, I'd like to think so. And I do feel that sometimes cyber insurance is, and I come back to cyber, but just as an example, sometimes it's maligned because people say, okay, the insurance product doesn't really work. It doesn't pay for this or for that. But to me, certainly our insurance product and some others in cyber as well, it's not just that promise to pay anymore. It's this concept of insurance as a service. If we think of car insurance, it's like valuing the breakdown cover more than you value someone just repairing the bonnet in all of that. And when we've got a small customer base, and the smaller the customer, the more vulnerable they are, and the more you need to look after them, having all those services around the cyber policy means that most of the time the promise to pay is not exercised. And sometimes those low loss ratios get looked at as inefficacy of the product. It's not at all. The product is doing its job by avoiding claims in the first place. So when you then get to embedding insurance, we had the Paul Ree article.
So presumably that just means you're going to have a slightly higher expense ratio anyways, but because you're providing such a luxury service.
Yeah. And sometimes higher expense ratios and in insurance are looked on badly. But actually, if they're delivering value to the customer, then they shouldn't be. From an insurance industry perspective, we play a combined ratio game, not just an expense ratio game. At CFC, we would always articulate the combined ratio virtues of our portfolio, and hopefully the syndicate has articulated that. But if the expense ratio is delivering benefits for the customer, like at CFC, it's that cyber threat analytics service that we provide for the customer, and we contact them via an app and let them know that potentially they're about to be attacked. And this is what they need to do. That's really valuable, but you don't see the value in the loss ratio. It's in the expense ratio. So high expense ratios or higher expense ratios.
They're not necessarily a bad thing.
They're not necessarily a bad thing for the customer.
It depends what you're spending on.
Exactly.
Anything else that we should expect to be seeing from you?
I don't think we're going to be jumping into brand new areas like marine hull or become a major property players. I think the market has plenty of very solid performers in those spaces. But in adjunctive areas for us, so certainly more penetration into the digital markets. 70% of our cyber new business inquiries, for example, are through digital channels. But really, we want to take cyber from its current penetration levels much more into the global psyche, not just in terms of a great proportion of customers in the UK and the other Anglophone countries buying cyber, but also cyber being bought outside of that Anglophone environment. Paul Ree yesterday was articulating some of the thoughts they've got about the cyber backstop. Yes. Part of that is because cyber insurance isn't getting right into the customer base that it should do, particularly in the SME space. And through those embedded channels, that's one of the things that we're going to focus on. The other is getting cyber outside of the Anglophone world. Europe is starting to really motor for us. But what we're trying to do, we've got a cyber toolkit that we feel is right up there in terms of not only the product itself, not only the technology, but all the auxiliary services. What we don't have is brand. We're a relatively specialist business. So what we want to do is partner with very strong brands in their territory. And we become the intel inside. We sit there with the cyber know-how, and they sit there with the customer recognition. And hopefully, as a partnership, we can increase the penetration of cyber in those geographies.
Those non-insurance brands, or some of them insurance brands?
Most of them will be insurance brands.
Yeah.
But insurance brands that aren't in cyber, would like to be in cyber, and who have customers that would like to buy cyber.
Yeah, for me, I would say cyber's got to be the ultimate embedded product, hasn't it? Because I think everyone needs cyber, even if they don't realize that they do.
Yeah.
You could throw it in with almost any purchase.
Yeah, I mean, it's almost irrelevant to no one, cyber.
Absolutely.
We need to get it out there, basically. And that's a big focus for CFC. But there's plenty of adjunctive areas for us, whether it's intellectual property and really advancing that as an area. We've been hiding it as a light under our bushel, writing a relatively modest amount of it. But again, as the world becomes more intangible than tangible, that's an area of our portfolio that we would really like to accelerate.
So you mentioned before about this M&A deal you've just done in Australia for insurance, because you've had a bit of M&A around building your service offering, but not necessarily pure insurance distribution world, buying another MGA. Yeah. This is the first time you've done that.
Yeah.
So you're saying that's a recognition you want to be global in that sense, that you want to be close to those customers, physically, geographically, someone you can go and visit in Australia, etc. Presumably there's going to be more of this to come. This is going to be something we should expect to see from you now, particularly now you're a maturing company, a much bigger company with access to that kind of capital. Expect to see more, I presume.
Yeah, I don't think you're going to see CFC become a serial acquirer. We have a very distinctive culture, very distinctive ways of working. And the solution acquisition, whilst we saw the need, with Australia being 10,000 miles away, to be closer to our customers there. And sadly, I'm old enough to remember what happens in a soft market with Australia. A lot of the best SME business, which is our bread and butter, stays in Australia. And we felt we needed to tap it at source. But when that feeling was coming, we also actually got to know the solution management team really well because we were trading with them. And we just felt a cultural kinship that we felt was too good to pass up. And really that led to that acquisition. It gives us 4 offices in Australia in addition to our cyber incident response office. They don't do cyber at the moment, solution.
So that's a bit of a good fit.
Excellent. So we have a greenfield platform with 4 offices on which to build cyber, transaction liability, tech, D&O, and other products. And they just feel like a great team to partner with. But in other territories, it's probably going to be more of a build. I mentioned Europe earlier. We've had 1 office in Brussels for a little while. We've just created an office in Amsterdam. We'll have 2 offices in Spain by the summer. They're all going to be builds. And what we've done in the US has also been a build.
Build generally, but buy when there's a real affinity and it's probably people you've known a long time.
Exactly. Keeping that cultural cohesion is really important. And I think to become a serial acquirer of MGAs with cultural differences, I think could be a management distraction when we've got our work cut out selling lots of products with lots of growth runway. And we need to focus on that, but increase our territorial footprint at the same time.
We need to talk about cyber itself. We're talking to one of the world's cyber experts. So where's cyber at the moment? It was up and now it's been sort of gliding down a bit. Mm-hmm. Is that about right to say where we are?
Yeah, and in certain pockets of the market, gliding might not be doing it
sliding
justice.
Or diving.
Our portfolio is predominantly SME.
This is more stable.
And it is more stable. We're seeing more of a glide. And conversely, in the hard market, you don't see it sort of soaring to the same extent as the mid and large market. But I mentioned in the context of the syndicate earlier, you see an absence of volatility of underwriting result. You also see an absence of volatility around rate, which has got to be good for the customer at the end of the day, wondering why their insurance was double the price one year and half price next year. That can't be good for the perception of the industry. But we are seeing lower single-digit rate reductions in the SME market and sometimes lower teen rate reductions in the corporate market. That said, one thing we do have, having 60,000 cyber customers, we do have a lot of data. And our data is telling us that rate adequacy is in a decent place for cyber. So, we can tolerate some of these rate reductions. And I think that's helped by the fact that we do have a cyber threat analysis team. We do have an incident response team. We are trying to get to claims before they're even claims. So to that extent, we feel that our rate adequacy point is perhaps lower than some others because we are actually intervening in the natural claims environment.
You're not just waiting for hackers to do things.
Exactly. Yeah. We're not floating in the market breeze on cyber. We're actually trying to interject there. But we do have the data literacy to know when we've reached the point where we have to put the brakes on or pivot in our strategy. Cyber criminals do not stand still by definition. And sometimes they pivot geography, sometimes they pivot industry sector. And writing a predominantly primary portfolio with a hell of a lot of data and a single source of the truth, we can see that what the criminals are up to, and our cyber threat intelligence team are most of them ex-intelligence or ex-law enforcement.
3 years ago, ransomware's gone completely crazy. And now we've got on top of that. Mm-hmm. What have they been cooking up, all these baddies?
Well, yeah, we saw ransomware going crazy. Then we saw them pivoting again to more like theft of funds, really intercepting bank transfers. Now, that for us was not necessarily a negative dynamic, and it's all a negative dynamic when it comes to crime. But theft of fund claims tend to be smaller, in that you're just recompensing the bank transfer. There's not that business interruption component that you need to adjust. So that wasn't necessarily negative, but we are now seeing more ransomware out at play. Again, we've had the Change Healthcare event in recent times.
That's a really interesting event, I would say, because when we're thinking about cyber and about systemic events or aggregation events, we always think, it's bound to be something to do with the internet itself or the people providing that core cloud infrastructure to the internet. We talk about cloud outage and we've spent a lot of money and time understanding those. Yeah. But I suppose because as everything becomes cyber to one extent or another, everything is digital. My business is digital. Your business is digital. Selling digitally. Yeah. Insurance becomes digital. Then, of course, new points of aggregation come into play. And now we've seen that it turns out in healthcare, once you've digitized healthcare, it turns out that shows up new aggregations that we hadn't necessarily thought about. That there's a supplier who supplies nearly everybody else, and then they've been hacked, and then we hadn't thought about that necessarily. I'm sure you had, being top underwriter, but we all live and learn, don't we? So what are we learning about that? The fact that we're not just talking about internet risk or web risk.
Exactly. I do think as an industry, and encouraged to some extent by cybersecurity firms and academia, we've been focused a little bit too much on Cybergeddon scenarios that you can measure in the trillions and that, the sky's falling down and everything's coming to an end. Great headlines, but in many ways, those scenarios
but it's far more likely, especially with insurance. What if one of the big three got really badly hacked? And it turns out they've counterparty with everybody in the whole world, pretty much, in the insurance world and everyone in the real world as well. So you think, actually, that's a very unpleasant but very realistic disaster scenario, isn't it?
Yeah, the way we view cyber exposure aggregation is in cube concepts. And what we mean by that is cyber exposures tend to aggregate at the intersection of geography, industry, and size segment. So we have an internal system called MegaCube. And what we try and do, and each of the cubes is a combination of geography, industry, and size segment. And we try and ensure our portfolio doesn't have too much in any one cube.
What's a size segment?
A size segment. So whether it's small business or large business.
Right.
So size of company. And if you look at the Change Healthcare event, it was in healthcare, it was in the US, and it affected predominantly small companies, small pharmacies.
Sounds like a game of Cluedo, doesn't it?
It is.
With the candlestick in the drawing room.
Yeah, and we've got a great visual for this system where you can sort of just click on a cube and you can see how much you've got and what's in it. And certainly having been in cyber now for nearly 25 years and having talked ad infinitum every single of those 25 years about Cybergeddon, but not yet seen it, and at the same time seeing natural scenarios confound models at every turn, whether it was, I know I'm showing my age now, like Cat 87J, which was that windstorm in the 80s, that trashed the models, or the Thai floods, or even the Baltimore Bridge.
It's because we weren't looking. Just turns out that, everyone had relocated their factory to somewhere along the Mekong River, and no one had really worked out that everyone had all done it over the last 20 years. And then turns out that they had.
Yeah, no, exactly, because everyone was looking at Florida.
Yes.
And it's like with cyber, everyone's looking at this sort of $1 trillion scenario, which affects most of the companies in the world, if not certain geographies. For us, it is actually smaller pockets aggregation. No, still damaging.
Some of those cubes can be quite big.
Exactly.
Yes, a cube has a nice defined sense to it, doesn't it?
Mm-hmm.
It's never going to be that big.
No. And, the way that the internet is segregating, because back 25 years ago, pretty much everything to do with the internet was Microsoft. And now there are so many more different companies. So the internet itself is much more diversified than it was when we first were writing cyber. So we do see it in that cube context. And each smaller aggregation scenario that does play out in reality, and we're running them right now through the Cyber Monitoring Center, every one of those instances actually strengthens our thesis around cubes.
Is it just fair to say that it's the nature of insurance? We can't know everything. We learn a lot of things when things that we didn't expect to happen. Bad things.
Yeah, it's the nature. I mean, the next thing in cyber, or indeed in many other classes, will be something that we don't anticipate. And in many ways, that is why we have been a sponsor of the Cyber Monitoring Center, because we don't believe that a cyber war exclusion or any other of the cyber exclusions that are popping up in policies, yes, they may be relevant, but they're just as likely to miss the next major cyber event, which we know from COVID that if you draft your exclusions poorly or you don't anticipate the next event, that can lead to terrible customer experiences and poor outcomes for insurers. So it's much better, in our view, particularly with something as new as cyber, and it's 25 years old, but it's still relatively new as a class, to try and ring fence your exposures, not by exclusions, but by scale of event. Just like in the windstorm space, where some people will cover named windstorms and national hurricanes.
By not putting too much limit in any one cube, I suppose.
Yeah, and even working, with what Paul Ree have in mind, to the extent that the Cyber Monitoring Center categorizes something as a Cat 5 cyber event, it might be that that's where Paul Ree steps in, and the insurance market have appetite and capital to cater for everything below that. But if you try and just ring fence your exposures with exclusions, as we saw from COVID, something will happen and drive its way through those exclusions.
The Cyber Monitoring Center, it's in its first year, which is it's sort of in beta, I suppose, is a way of describing it, isn't it? It's working, but it's not publishing anything at the moment because it's just working out its methodologies and testing stuff. So something like this healthcare incident, would that be an event?
Yeah, it would be an event, and we would run it through it. I mean, I can't say at this stage what output it would have in terms of would it be a Cat 1 or higher. But what we are doing with the Cyber Monitoring Center now, and I say we, Kieran Martin, and a technical committee of 6 now. And whilst we've been a seed sponsor, it's very much an independent body, very independent of CFC and indeed of insurance. What the center is now doing is running through historical cyber aggregation scenarios that have happened from NotPetya to many of the others, running those scenarios and see where it winds up on their scale, just to test the calibration methodology such that we're then ready to roll it out into live next year for the UK and then beyond.
How's it going in terms of, this is your kind of call to the industry, you were the instigators of this and you kind of set it off. Has it had enough funding and uptake from other members?
It's gained a lot of interest. I mentioned Paul Ree, and our conversation with Tom Clementi and the team there continue about its relevance to Paul Ree, but also in talking to our 30 capacity providers and indeed capital providers, they're very interested to see how it plays out. So I think there's a lot of appetite, knowing that debates like the cyber war exclusion, the exclusions were well-intentioned, but when you've got a bunch of SME customers and you've got to say, well, hold on, we're not going to pay you out just while we see if anyone sort of holds their hand up to this being a war event, or we can suss it all out. That's not good financial services. And to the extent that we can make the Cyber Monitoring Center,
at the point of delivery, they should be paid out and then we should be working out who we're subrogating on.
Exactly. Don't make it the customer's problem.
Yes.
The cyber war scenarios where everyone had to pause while we're waiting on attribution, and wars, particularly cyber wars.
You don't declare cyber war on anyone,
No.
do you? You just do it.
So it was conceived in the lab, but I don't think necessarily road tested in reality. And something like the Cyber Monitoring Center hopefully allows a much more transparent and customer-centric way of delineating where insurers' responsibilities stop.
Something I want to ask you about, another one of these things that we've all been talking about, perhaps that insurtechs that sort of really got into over the last 3 or 4 years would be parametric covers. And we've seen parametric covers coming into cyber, particularly for cloud outages, what I've seen a couple of products. What's your view of that? Do you think it's going to penetrate further into cyber? And obviously it's nice because it gets rid of that problem of attribution. It's a binary thing. Has it hit this number or not? Bang, you get paid or not.
Yeah, and I do think they do have relevance. One scenario is to solve the problem of attribution.
Do you think you'd be selling one?
I think
probably not to SMEs.
Yeah, well, this is it. And I think one of the other problems we've experienced, particularly over the last few years, is not the problem of attribution, but the problem of adjustment. So cyber can be very short tail in many of its scenarios. You're either sort of recompensing someone for a bank transfer that went into criminal hands, or you're reimbursing a ransom payment. And that's all very quick. Adjusting the business interruption can be slow and painful. It's not necessarily as clean and cut.
It's always been slow and painful.
I know.
Because you get into things like, you want to now... Obviously, if you had Windows 10 computers, which is why they got hacked, then of course you're going to replace them with Windows 11 computers. So now you're talking about betterment and all this other stuff and things that your client doesn't necessarily understand.
Yeah, and if a building burns down, it burns down, and your hotel, let's say that it's a hotel, your hotel's not functioning. Whereas your systems tend not to be down in whole. It tends to be down in part. And therefore, you've got to slightly unpick the revenue
functionality,
impact.
But how much can you define?
Exactly. And it's a bad experience for the customer. So you have an unhappy customer. Even if he gets paid at the end, he's annoyed because it took 2 years. Whereas parametric could come in, and parametric's a word that gets thrown out. But if you just have a predefined schedule of benefits, such that if you're down for a day, you get this much. And,
it's like BI in commodities where you actually have a pre-agreed value.
Exactly.
Because, the oil price goes up and down all the time anyway. Yeah. So why don't we have a pre-agreed value?
And as long as you can make it proximate to what you feel their business interruption would be. And obviously you get a sense of their revenue as you're taking them on as a customer. So you can try and get an approximation of indemnity, but it's preset at the outset of the policy and therefore pays out really quickly. And potentially you can use tech just to basically pay, here's your daily payment.
So we should watch this space, might see some enhancements with parametric features in them in some of your products.
Indeed, watch this space.
AI, we can't be sitting in 2024 not talking about AI. Obviously, you really understand technology, and you've always been a technology-focused underwriter. Even just for ingestion, I've always known you to be very keen to make things easy for the broker or for the customer, ultimately. To anything you can digitize, you have done over a long period.
Yeah.
Presumably you've been all over AI for a long time anyway. Well, certainly on the underwriting side.
Yeah.
How far do you think you can go?
Yeah, and of course AI is an expression like parametric that gets thrown out almost in every sentence and in every article. And I guess from our perspective, we're using it to both improve the customer experience, but also to improve our underwriters' working lives. And AI often gets talked out in the context of, is it going to replace underwriters? Now, we see it differently in that, when you're writing small business, a lot of the business that you write, it's in your appetite sweet spot. There's nothing particularly nuanced about that company that gives you cause for concern. And our rating models and our pricing is all calibrated centrally. So from an underwriter, it's a bit of a no-brainer. So it's not the most interesting thing that he's going to do that day is underwrite that risk.
So the more you can automate it, the better.
So if you can get the machines to do the no-brainer stuff, you can take the people with brains and personalities and characters to do the stuff that only humans can do. And to me, first and foremost, that's selling. To go and build relationships with your brokers, their customers, our digital distribution partners. But it's also the fun thing. And it means you can get on planes and trains and go and see brokers. And that's the rewarding part of insurance that we all enjoyed when we entered the market. And if you can get the machines to do the transacting and the humans to do the selling. And I always remember the David Howden quote, insurance is never bought, it's sold. And we need to get on and do more selling. And if the machines free us up to do that, not only should we do more insurance and increase its penetration and relevance to the customers, but we increase the quality of our underwriters' working lives. And to me, that's where AI plays.
So it's more about productivity.
Yeah, not just productivity, but it's insight too. To the extent that AI can see that a customer has a vulnerability that the customer wouldn't know if we asked them. And our underwriters wouldn't be able to tell from an application form. To the extent that the AI can see that vulnerability because our data is telling us that this is what the criminals are targeting, that improves our underwriting, but also enables us to help the customer and say, look, this is what you need to do to cover off that vulnerability. But it can help in other ways, and this is just the practical application of the way we're thinking about AI at the moment. For example, we get thousands, hundreds of thousands of submissions in every year. Some are hot prospects, some are not. But if you can teach the machine which ones are hot prospects, and there might be hot prospects because it's bang with an appetite, or in fact, it's in the UK time zone and it's the morning, so don't bother quoting a US risk at this stage.
They're not awake yet.
Yeah, so the machine can prioritize. It can say, actually, with this broker, we do really well on professional liability, but we're not actually that good with them on cyber. So it deprioritizes the cyber account and puts professional liability to the top. So it almost probability weights your chances of success. Because if you think of insurance and you might have a 20% conversion rate or 15% conversion rate, another way of saying that is you don't get paid for 80 or 85% of the work you do. So it's inefficient from that perspective. If the machines can make you more efficient and get human beings more wins, human beings feel better and they have better jobs because of that. So getting the machine to learn that what our chance of success in that particular inquiry is. And obviously that's not a static bit of learning. All the data that comes in teaches the machine to more accurately predict our chance of success. That makes us a much more efficient business and is better for brokers and customers.
And AI is never going to go out selling, I presume.
AI
worked out a way of making it do that yet.
Yeah, I think that's a little way off. And even behind the most digital of platforms, there's a bunch of humans. And those humans need talking to and understanding and seeing what the configuration is on that platform and how can we optimize our performance with it.
Can't really have difficult conversations with AI.
No.
What about AI from an underwriting perspective as an underwriting peril? And obviously, when you're talking about media liability, talking about IT, E&O, that kind of thing, you think people who got sloppy, got over-reliant on an algorithm to do something for them, on a bit of AI to do something for them, and they've created a systemic problem within their business, that kind of thing. They've replicated an error 1 million times and fired it out to all their customers.
Yeah, there's no question as AI becomes more embedded in society, and I think we're still in the foothills at the moment, the exposures are potentially material. We write a lot of media business.
Yeah.
And when you're seeing the deep fakes and the machine generated impersonations, that can give rise to media exposures. So our innovation team is not just about creating new product, but it's also thinking about how our existing product and underwriting appetite needs to evolve to new exposures. So it is absolutely one of the key concerns that we have, because we tend to underwrite exposures that have only come about because of the technology revolution that started with the internet in about 1990, whether it's cyber or tech or digital healthcare. Our exposures all have technology underpinning them. So this next generation of exposures relating to technology is something that we are watching extremely closely.
Have you got a kind of cube methodology for that yet?
Too early, but we're working on it. Yeah, it's one of the things the innovation team is tasked with.
Yeah, absolutely. Well, good luck with that. If you can crack it, you've got a huge new sector of business. We were talking about the next cyber sort of AI E&O is going to be quite entertaining, isn't it?
It absolutely is. And it presents both excellent opportunities, but significant threats.
Absolutely. Andy, I've really enjoyed talking to you. It's been really good fun.
Likewise.
The sun was shining and you've got a spring in your step and you're up to all sorts of things. So
Indeed.
Thanks so much for letting me know about some of them and for all your thoughts on all the other things as well.
Thanks for inviting me on. Appreciate it.
Great. We'll have you back on the show soon.
Indeed. I look forward to it.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.